Good afternoon, everyone. I want to welcome you all to our Learn at Lunch webinar. Today, we will hear from Extension Farm Policy Specialist, Dr. Amy Hagerman, as she provides an update on current farm policy. You may ask questions using the chat window. Open the chat window by clicking the chat button at the bottom of the screen. Dr. Hagerman will answer questions at the end of the webinar. More farm management resources may be found on the eFarm Management page. I will share this link and a link to the Ag Policy page in the chat window. Our next webinar on December 19th will look at the impact of drought and disaster relief insurance on rural Oklahoma communities. Dr. Hagerman, I will turn it over to you now.
All right, thank you, Brent. So some of you may have seen some of this before, but we are actually starting to get into a fairly fast-paced time period for this farm bill. I think in the next 6 months, we will see a lot happen in this space. So what we're going to do today is talk a little bit about where we are, some of the information that's shaping the current discussion around it. And I am going to focus a little bit on farm programs for this, discussing some of the potential changes that are being proposed. So where are we at, right? The big question, of course, is when is a farm bill going to pass and what's it going to look like whenever it does pass? So we have been under an expiration since September 30th of this year for the 2018 Farm Bill. That actually doesn't affect 97% of the programs and spending in the Farm Bill. There are only 19 programs that did not have any sort of underlying appropriations or permanent authorizations that allow them to continue. So those 19 programs in stasis, if you will, while we're waiting on either a continuation of the 2018 Farm Bill to pass or a new Farm Bill. At this point, it looks like we're going to be under a continuation. If you've been following the news, they're putting a continuation and extension of the 2018 Farm Bill for 1 year in the continuing resolution that's under discussion right now for the agriculture minibus continuing resolution. And so it looks like probably as of this Friday, we hope, unless we roll over and go into a shutdown, that we will have an extension on the current Farm Bill. What does that mean? That means that at least for the next year, or at least probably for the next program sign-up period, right? Because most of the sign-ups happen around March 15th for a lot of programs, and even you can get out into May for some of the crop insurance and things like that. But for at least the short-term signups happening between now and March, we will be under programs that look very similar to what we have seen for the last 5 years. So probably a 1 year continuing resolution. Does that mean it will take a year to get a new Farm Bill? Maybe, maybe not. We don't really know at this point because we haven't seen language come out of committees yet on what those bills look like. And that's going to give us a good indicator about how hard it is going to be to actually come to a middle ground, to come to a final bill that is something that both parties and both the Senate and the House will pass. And that's right, that's the real kicker right now. So today we're going to look just a little bit crystal ball, right? Nothing is set in stone, but we're going to talk about how the changes that are being proposed right now and that are under discussion right now might affect Oklahoma. So we're going to start on the commodities title. This is one where we've seen, at least for our farm groups, a lot of discussions, some priorities being emphasized on both the commodities title and the crop insurance title. Now on the crop insurance, the focus has mainly been on maintaining availability and affordability of crop insurance. So not necessarily a lot of proposed changes, but more so don't cut budget here. That's been the main focus of conversation around the crop insurance title. But for the commodities title, there has been a lot of discussion around both reference prices and base acres. So we're going to dive into that a little bit more. So for those of you who maybe weren't around whenever we were doing the last Farm Bill, for example, why are reference prices so important? So our safety net has two parts. It has the ARC and PLC programs, agricultural risk coverage and price loss coverage programs, and it has crop insurance. But right now we're focused on those ARC and PLC programs. Each year, producers make the choice of whether they want to primarily focus on price risk protection through those two programs, or if they want to focus on revenue protection. So if they want price, they're going to go with PLC. What does that mean? When the marketing year average falls below this critical price level that's established by USDA and Congress, then the PLC program pays the difference, the gap between those two prices. So it's that price gap, which is a per bushel price gap multiplied by the farm specific PLC yield multiplied by the number of eligible base acres. That's how that payment is determined for PLC. ARC is a little bit different. ARC has really two versions, ARC individual and ARC county, but almost all of those who have enrolled in ARC have gone with ARC county. So I'm just going to focus on ARC county today. ARC county uses a county average information to create a revenue guarantee in any given year. And if the revenue for that county falls below the actual calculated revenue using actual yields and actual prices, but again at a county average, falls below that guarantee, then the ARC payment triggers. So it's dependent on both the prices, the marketing year average prices and those reference prices for the guarantee, and the actual revenue, but it's at the county level. PLC is at the national level, ARC is at the county level. PLC is price protection only, ARC is both price and yield protection to a certain extent. So why do these things matter? It's going to affect how these programs may trigger going forward in the base or in the future. And then the base reallocation determines what crops those decisions are being based on. Okay, so let's look at a comparison of ARC and PLC just since the last Farm Bill, the 2014 Farm Bill was put into place. If we look in 2015, you can really see why people started out in ARC. ARC looked like it was going to make pretty good payments at the national level. There was a lot of discussion around that. But then we saw this movement, this shift, especially here in Oklahoma, as we started to get into lower wheat prices, because we have a lot of wheat base acres in the state, that people were really kind of hoping that they were actually in PLC at that point. And this drove a change in the 2018 Farm Bill, where instead of having to pick one program for the entire 5-year program, you had to pick either PLC or ARC under the 2014 Farm Bill. In 2018, people were able to change that election each year. And you definitely saw people starting to make that change. In 2019, you saw a huge shift over to price loss coverage. People were really concerned about prices in that 2019-2020 year. And so you saw this shift over into PLC from ARC, especially in Oklahoma. Now, bear in mind, these numbers, these are payments, so obviously they're weighted by how many acres you have in each one of these programs. But that's where this blue line gets really big. You had a lot of acres shifting over into PLC. So when PLC did trigger, you had a lot of payments under the PLC program. 92% of our base acres in the state moved to PLC in 2019. But then as prices began to improve, if you look forward to the 2022 election, which is our 2023 crop, then you saw this shift into ARC because prices were improving, but people were really worried about drought. And so you saw this shift over into this program. So people are responding by shifting around between these two programs. If we look at ARC and PLC payment rates for this year, the ones that were just announced at the end of September, this is the 2022-2023 marketing year. No PLC payments were triggered at that time. It's just prices were simply good. And that's what we'd rather have. We'd rather have good prices for marketing crops than to have prices that are so low that these programs trigger. We had a limited number of counties that did trigger ARC payments in that year, and that was yield driven. These were the counties where we saw drought, we saw other kinds of weather challenges that actually dropped revenue below that guaranteed revenue for the county. If we look at current price projections for the coming year, and these are very early price projections, so, you know, we don't want to get too caught up in these, please, because it is way early in the marketing year. Right now, it's not looking like, even looking at some of the different price projections for the next year, it seems like there's pretty limited potential for PLC to trigger for a lot of commodities in the coming year. Seed cotton may be the exception to that, and we'll talk a little bit more about seed cotton. ARC County triggers, again, are going to likely be yield driven, and it's way too soon to be able to say what that may look like for the coming year. But I think if we're talking about this 1-year extension, then we are looking at business as usual, if you will, under ARC and PLC, and how those calculations are made in the coming year. So let's take a quick reflection back on those marketing year average prices. We can see here that reason why people may have been shifting away from the price loss coverage and into the agricultural risk coverage in the last few years, as we kind of move along this trend over time. So what changes are being proposed that could actually affect that going forward into the future? The first is the potential to raise reference prices. So if we look at where reference prices are today, and if you look on the left-hand side of your column, that line of numbers, $5.50 for wheat, $3.95 for sorghum, those are your statutory reference prices for each year. Then if you look at the bar graph on the right, this is showing how those reference prices actually compare to a 5-year stretch of costs of production. So the left-hand side of the bar is the lowest price or the lowest cost of production in that 5-year time period. And the right-hand side of the bar is the highest cost of production or the highest marketing year average price in that 5-year time period. The right-hand side of that bar is 2022 for each commodity for both the cost of production and the marketing year average prices as you go down the list. So if we look at how these reference prices compare to costs of production, we can see that we've got a pretty good gap between where the reference prices are and where prices and costs of production are as well. Better in terms of prices, right? Our reference prices are tending to fall a little bit more in our blue bar for cost of production, except for soybeans, which soybeans has not triggered a PLC payment in the last 5 years because the soybean reference price is $8.40. Remember, a lot of these reference prices were established about 10 years ago at this point. And bear in mind, as you look at that cotton price, that is seed cotton. So it's the lint and the seed together. Where is my, there it is. Okay. All right. So now we're going to get really wild and we're going to do some comparisons here. This is a very busy chart, but I'll try to break it down and kind of make it make sense. So first, let's look at the column closest to the chart. This is the effective reference price. So in 2018, a change was made for reference prices. They call them elevator reference prices. So if in the last 5-year period, if we take an Olympic average, which is dropping the highest and the lowest price in that 5-year period, and we take 85% of that Olympic average, then the reference price, the statutory reference price, then they will use that effective reference price. We've been waiting several years for these to kick in for some of our major commodities in Oklahoma because we have had prices going up over the last few years. And in the next marketing year, the 2023-2024 marketing year, I think we could see some of these kick in. USDA hasn't said this officially. These are my calculations. Don't get too excited about them. But It looks like we could actually have some of that kick over. So these ones in green for sorghum, soybeans, and corn, these are the ones that have the potential under this elevator reference price to actually go up a little bit in the coming year. So again, we're waiting on USDA to come out with their officials. They are the ones with the final say on this. But if I do the math, I think there's the potential, especially for soybeans, to see this effective reference price change happen in the coming year. And we can compare that, though, to the middle set of numbers, which is our projected 2023-2024 marketing year average prices. This is USDA Farm Service Agency projections. So the ones who are actually establishing the marketing year average price at the end of the year. Again, very early in the marketing year. Don't get too excited about these. But I did just want to show the potential as compared to the elevator reference prices for the coming year. And so we can kind of see there that, you know, for wheat, it's still, our projection is looking like it's going to stay nicely above 550. But then if we look at sorghum, and then we look at seed cotton especially, you know, maybe we're getting a little closer to that trigger, which just means we could be a bad event away from having to use those safety net programs for those that are involved in them. Well, now let's think about a 10% increase in reference prices. And I want to emphasize this, and I've got it red down there at the bottom. This is for comparative purposes only. If we did get a change in the reference prices in this farm bill, it would not kick in for the 2023-2024 crop year, right? We'd be further out in the future. But I just wanted to say, okay, inside our current market information, would this make a difference? And I think you can look down there for seed cotton and see that, yeah, potentially it could make a difference for seed cotton producers. Soybeans, the reference price to start with is so far below where a lot of our soybean prices have been. I'm not sure it's going to make a big difference for soybean producers, which is where they're going to continue to lean probably towards that ARC program. But then, you know, you look down there at some of the other, like for wheat, that's actually going to get a little bit more protection in the coming future. So would effective reference prices make a difference? Yes. Are more so than what a 10% increase in prices or in reference prices would be? Maybe not. So I just wanted to point that out there for you guys, that it's technical. There's a lot of calculations involved there, but I think in terms of actual protection for producers that have some fairly high costs of production in the last few years, especially, this could actually change the safety net that's sitting underneath their operations going forward into the future. Will it actually happen? Right? That's always the question. And I think cost has been a real sticking point for this Congress. They are looking for ways to cut costs, and that includes Farm Bill programs. CBO's score of increasing reference prices has a price tag in the billions, even for a 10% raise, much less a 20% or higher increase in those reference prices. And partisan lines are definitely being drawn about where those spending cuts happen. So I think there's some general agreement that there won't be new money in this farm bill, but where, if any, will the spending cuts happen to make room for increases in other places? I think there's a lot of differences of priorities for that. Okay, now let's go to the second proposal that has happened for commodities. Remember, I talked about the payments for ARC and PLC for an individual producer. It's multiplied by the base acres on their operation. Base is simply the historical production for your operation. So, for example, on a family's operation, maybe they are growing, you know, summer crops rotated with wheat. Then they'll have wheat base. If they have moved it even into grassland, but historically it was a wheat operation, it maybe has wheat base. If it's currently in CRP, but was historically in wheat, then it might have wheat base underneath it. So where is the base in Oklahoma? Well, if you look at these orange bars, this is where the base is for the state. So what people are signing up for these ARC and PLC programs on. And you can see most of it's in wheat base in the state. We've historically been a wheat state, but we have had these increases in planted acres, which is the gray bars, for soybeans, cotton, green sorghum, corn. And at the same time, we've had some decreases in those wheat acres over that time period. So if we come around to a base acre update in this next farm bill, depending what it looks like, is it voluntary? Is it mandatory? There may be some opportunities to shift base over to some other crops. Now, we just talked about soybeans hasn't really triggered many payments in the last few years. Well, if you're a soybean producer that has peanut or oat base, something that has actually triggered payments more frequently, you might not want to change your base under a voluntary base update. It just all depends on the operation. It depends on the county. And so we'll have to see the impact on that. The little black boxes are actually the percent of acres insured under those different crops. And you can see the real emphasis on crop insurance in some of these crops. Now, you know, even pay attention to that scale, right? Everything is above 80% in terms of the percentage of acres that are under crop insurance protection in Oklahoma. But that kind of leads us then into our next piece of the puzzle, which is crop insurance. My time here. So the cost for crop insurance is increasing for both producers and for the government for a couple of reasons. First, crop prices are increasing, and that's going to have an influence on that. Also, in terms of the government cost of crop insurance, the number of crops that are covered has expanded. Since 2019, we have 130 more crops nationally that have some counties that have crop insurance coverage available. Also, you saw those high numbers in terms of crop insurance uptake. You have more producers that are taking crop insurance as a risk management tool. Lenders are very interested in producers managing their risk in some way, and crop insurance is one way to do that. It's pretty readily accessible at this point. In 2022, we had $19 billion in crop insurance indemnities nationally. Remember, we had a lot of things happening in 2022, not the least of which was the drought we were experiencing here in Oklahoma, but you also had hurricanes, which caused flooding. You had freezes. There was just a lot happening nationally. And those are the kinds of events that do tend to push people further toward taking on crop insurance as a part of their risk management for their operation. But from a federal perspective, they're going to cite those rising costs of crop insurance, and they're concerned about that in terms of federal outlays for the crop insurance program. Remember, I had said this is a pretty cost-conscious Congress this time around. So there is some interest, though, in increasing the incentives for these area policies. They're called area policies because they trigger based on what's happening in your area. So that's the enhanced coverage option, the supplemental coverage option, which you can only have if you've elected to PLC, and the STACS program, the Stacked Income Protection Plan for cotton, which I've seen more people moving out of STACS because they've been participating in the ARC and PLC program instead. So if we look at the total policies sold for 2022, this is a large number of policies sold for the state of Oklahoma, but a pretty small portion of those have actually stacked that higher level of area coverage. That graphic over there on the bottom right-hand side, that's just an illustration to show you how these different programs work together. So you've got your multi-peril crop insurance, that's your basic crop insurance. But if you want to get up to a little higher level of coverage, you're stacking the SCO or ECO options on top of that. So if we look at SCO and ECO, we can see that we don't have a large number of those people who have multi-peril crop insurance that are actually stacking those higher level coverages on top of that. So I haven't heard any great proposals for how that's going to be changed in the Farm Bill talks, but it's a discussion point that people are bringing up, that they would like to see increased use of those higher levels of crop insurance. Then we come to conservation. So conservation is something that we have used intensively in Oklahoma, just because we have the kind of land and the kind of weather that makes conservation programs something that producers are really interested in utilizing. In the Inflation Reduction Act, we saw a large increase in the amount of money going to these programs. So if we think about environmental quality incentives programs and conservation stewardship programs, these are our working lands programs. This is the land that's still in production. $18 billion are going toward all of these programs, but especially like this EQIP and CSP program. Those are the ones we're most interested in. Interestingly, at least in the first year, in 2023, that Inflation Reduction Act money went to mitigation practices. So we're talking about nitrogen management, we're talking about carbon sequestration in the soils. That's what the focus has been on in year one. We'll have to see what is announced going forward into the future, but it looks like there's going to continue to be an emphasis on those conservation practices that contribute to mitigation of greenhouse gases. That doesn't mean that all the other practices aren't still available under what we'll call traditional CSP or traditional EQIP. It just means that that additional pot of money, if you look at the difference between the blue bar and the red bar, that additional pot of money is going to be for those practices that have had historically or analytically shown some potential benefits for mitigation. So that's just something to be aware of for the coming year. Rural development has been another topic of interest in these Farm Bill discussions. It came up every single Farm Bill hearing. Rural development and things like the infrastructure in rural communities, like sewage systems, water systems, utility systems. Also the emphasis on renewable energy and how rural communities can benefit from renewable energy development. So here we have historically talked about wind power in Oklahoma for this, but I think solar is the new conversation around renewable energy in Oklahoma. Water availability and water quality is coming up on this. We've all seen in the news some of the discussions about water quality in various communities. The broadband, we saw a lot of CARES Act money come to Oklahoma for broadband enhancements. And so broadband is part of that conversation historically as well. And then also labor availability. Most of the labor discussions have happened outside of the Farm Bill historically, like the H-2A program. But if we think about the impact of labor availability on being able to draw more of those dollars into rural communities, that becomes a real conversation point. So this is the 2021 food dollar that's put out by the Economic Research Service. It basically takes every dollar that's spent at the retail level and breaks it down how much of that dollar goes to different sectors in bringing that product up to the retail level. And so you could kind of see this breakdown of where that dollar goes. And I think there's interest, certainly in Oklahoma at a higher level, and bringing more of that value added into the state and actually keeping more of that dollar here. And in rural communities, keeping more of that dollar in rural communities. But that's going to mean labor availability. And we all know that there have been challenges in terms of finding the available labor for certain kinds of positions. Okay, let's talk about disaster programs because I'm trying to stay on track here for Brent. So let's talk about disaster programs. We have seen an increased use in disaster programs, in ad hoc programs across the country, especially post-COVID. But I think in Oklahoma as well, we're a disaster-prone state. Let's all just be real about that. And so these disaster programs tend to be very important for us in helping to smooth out some of the interruptions to business that comes about as a result of that. So we can break that down in terms of what those disaster programs looked like a little bit more clearly. And if we look at 2020, we saw this was a lot of pandemic assistance. So this was the Coronavirus Food Assistance Program. This does not include PPP. For those who participated in that, it does not include EIDL loans. It's just the USDA pandemic assistance is that blue bar. The non-USDA pandemic assistance, like PPP, that's the orange bar. Well, if we look at 2021, we can see that movement away from pandemic assistance, USDA pandemic assistance into non-pandemic assistance. And then if we look at 2022, we're back to our more historical use of ad hoc programs, which is more disaster programs. So emergency relief program, emergency relief for livestock program, which is the replacement for WIP and WIP Plus. And those were largely drought driven. So the timelines for the next Farm Bill are very uncertain. Cost outlays are probably going to be a big conversation point in what changes, if any, we see in this Farm Bill. I think the signal that we received by the willingness to put an extension in place is that we're not going to get just a continuation of programs that look like the 2018 Farm Bill. There is actually some appetite to make some changes in the Farm Bill. No discussion about what to do about crop base that's in grass. If you'll remember in 2018, anybody who had crop base that was in grass or had been in grass since as of 2017, was put into the Conservation Stewardship Program, Grassland Conservation Initiative, the GCI. That's expired with this expired Farm Bill. So what is that going to look like at this point? We also have unassigned base in the state for those who had cotton base. You might remember distributing things between cotton or other crops, but then you had this portion of base that went to unassigned base. There hasn't been any discussion of what to do with that yet, at least publicly. And then I would say generally there seems to be support for continuing the livestock programs. A lot of those are permanent under the 2018 Bipartisan Budget Act. Some big changes were made in 2018 in those livestock programs. And there seems to be continued support for that. So with that, I'm happy to take questions. The survey link for this webinar is down at the bottom of the slide. Does anyone have any questions?
Participants are able to unmute themselves and ask questions, or you may ask it through the chat window.
My email is there if you would like to email questions as well. It's a lot of alphabet soup. So if it was just like, what are you talking about? What is this acronym? I try to say what the acronyms are, but I do eat alphabet soup every day. So if you guys have any questions about what the heck a program is, feel free to reach out as well.
Thank you, Dr. Hagerman, for the good presentation. I did also share a link to the webinar survey in the chat window as well to click on there. Also, I wanted to remind everyone that we do have our next webinar scheduled for December 19th. It's a Tuesday at noon again. And it will also be on the impact of drought and disaster relief insurance on rural Oklahoma communities.
So I will say too, if we have anyone on here that maybe hasn't been through a farm bill in the past and you'd like to get a little more information on just the basics of what some of these programs are to better understand what these changes are, I am definitely open to doing maybe an in-service or something that's just on the basics of these programs. So if you have a desire for that, please reach out to me and I would be happy to set that up.
I haven't seen any questions, so I think I'm going to end the recording and end the webinar. So thanks again, everyone, for joining us today. Thank you, Dr. Hagerman, again for presenting today, and we will see everyone on December 19th.
All right, thank you.
You're welcome.